Hello. In today's session, we'll be taking another topic, which again is pertaining to principles and practice of banking, that is Basel III. You're already aware that what the Basel I and Basel II talk about. Well, to recapitulate, Basel Accords were introduced basically to strengthen the stability of international banking system. Now, Basel III was introduced with a intention because of the financial crisis, the global financial crisis in 2008, felt the need, the necessity of strengthening the banking system. The banks in developed economies were undercapitalized, over leveraged, and had a greater reliance on short term funding, which resulted in many bank failures, and as a result of which, the committee met again and deliberated how to strengthen these banks, what improvements are required in Basel II, the quantity and capital requirement so that bank failure should be stopped. Earlier, the Basel I and Basel II were deemed to be insufficient to contain any further risk, and that actually triggered for Basel III. Let us have a look at the journey of bank capital regulation. All of you are aware that the G10 countries started this Basel Committee work, and in 1988, the first accord known as Basel I was issued. It was fully implemented in 1992. Subsequently, some amendments were made. In 96, market risk amendments were issued, and in 1997, market risk amendments were implemented. Considering that some more improvements are required to strengthen the banks, in 2004, the committee came out with new guidelines, which is called as Basel II, and in 2006, Basel II was implemented. In 2009, revised securitization and trading book rules were issued, and in December 2007, the advanced Basel II approaches were implemented. Now, having already said in 2008, the global financial crisis triggered the need for further improvement in the system. So they met again, deliberated the issues, what should be done to strengthen the banks, particularly the international banking system. In December 2009, Basel III consultative documents was issued. And in 2011, trading book rules were implemented. The Basel Committee informed the international banking regulators that Basel III should be implemented in 2013, and accordingly, the regulators issued in turn guidelines to the banking system in their countries to implement the Basel III guidelines. Let us now look at the regulations which are required and to be implemented under Basel III. Basel III, as I said, is a continuation of the earlier two guidelines, and this accord now seeks to improve the banking sector's ability to deal with financial and economic stress, improve risk management, and strengthen the bank's transparency. So, the pillars under the Basel Committee recommendations remain same. They have not been changed. Let us now have a look again at the three mutually reinforcing pillars. Pillar one, all of you are aware, that it talks about the minimum regulatory capital requirements based on risk-weighted assets. Minimum capital is calculated through credit, market, and operational risk areas. Pillar 2 talks about the supervisory review process, regulating tools and frameworks for dealing with peripheral risk that banks face. Pillar 3 talks about market discipline, increasing the disclosures that banks must provide to increase transparency of the banks. The Basel III, the pillars remain same. There is absolutely no change as far as this structure is concerned. Let us now have a look at what are the major features of Basel III. There are basically we'll be discussing about four features. First feature talks about better capital quality. What do we mean by better quality capital? It means capital which has higher loss absorbing capacity. This in turn will mean that banks will be stronger, allowing them to be better withstand periods of stress. Hopefully, this will take care of the problems which the banks faced in the global financial crisis way back in 2008. The second important thing which has been brought out in Basel III talks about the capital conservation buffer. Now, in addition to the capital which is required to be maintained by banks, banks are now required to hold capital conservation buffer of 2.5%. The aim in asking the banks to hold this capital conservation buffer is to ensure that banks maintain a cushion of capital, and this can be used to absorb losses during periods of financial and economic stress. So this will take care, particularly when the banks are facing the financial and economic crisis. Third point talks about the counter-cyclical buffer. Now this has been introduced with an objective to increase capital requirements in good times and decrease the same in bad times, because economy runs through a different cycle. There will be periods of good periods. There will be periods when the banks will be facing problems. So this buffer has to be created during good times, and the same will decrease during the bad times. The buffer will range from 0% to 2.5%, consisting of common equity or other fully loss absorbing capital. So this will strengthen the bank's capital in a better way, and particularly when the banks are in passing through a good period, they will be able to keep this as a buffer, and that will take care during bad times. The fourth important thing of Basel III is about the minimum common equity and Tier 1 capital requirements. The minimum requirement of common equity, the highest loss absorbing capital, has been raised under Basel III from 2% to 4.5% of total risk-weighted assets. So earlier for Basel II, it was 2%. Now under Basel III, it will be 4.5%. So Tier 1 capital requirement, consisting of not only common equity but also other qualifying financial instrument, will also increase from the current minimum of 4% to 6%. Although the minimum total capital requirement will remain at the current level of 8%, yet the required total capital will increase to 10.5% when combined with the capital conservation buffer. So this is definitely an improvement over Basel II. RBI has put a timeline for completing the Basel III Accord. So as I said, 2013, the Basel III Accord was implemented, and the timeline, various timelines which have been given by RBI are appearing on your screen, and by 1st January 2019, the entire Basel III requirements has to be completed by the banks. So to talk about the common equity tier requirements as of March 2018, the banks are required to maintain 7.375%. 7.375%. What happens if the banks do not maintain this capital requirement? Basically, the banks will borrowing cost will go up, both domestic as well as international market. So that is going to add to the cost of the banks. So in their own interest, banks will have to strive hard to maintain CET1, that is Common Equity Tier 1 capital, that is called as core capital. So this is an important requirement and they will have to complete it by 31st March 2018, the requirement stipulated by RBI. Otherwise, they will be incurring additional cost. Now, to conclude, we can say in a nutshell that Basel III is an accord agreed upon by the members of the Basel Committee on banking supervision on bank capital adequacy, trust testing, market and market liquidity risk. So this is all about the Basel III.